Hi, welcome back to the channel. Now, before I switch over to my screen share and walk you through all of the charts and the data that I know you all tune in for, it's been a wild few weeks. We've had earnings season, there's been a lot of chop, and I hope my work has helped in some way. Now, there continues to be some massive upside moves in a lot of the beaten up areas, as well as the flight to safety in mega cap tech, which is of course set against a backdrop of massive economic turmoil. So in this video I'm going to walk through a lot of the charts and the data that will hopefully make sense. As always, I'll walk through a high level broader market analysis with a lot of key stocks and ETFs, and I think you'll probably find a lot of value from my work. Now, everybody's asking if the market's already bottomed, or is the credit event, the economic collapse that everybody's expecting, just around the corner. On one hand, you've got a lot of the perma bears screaming that it's just a matter of time, and on the other hand, we've got a lot of the perma bulls screaming that the market bottomed in October. Now, I'm neither a perma bull or a perma bear. I'm very open to all outcomes. I analyse the data as it comes in, and if you're paying attention to a lot of the mainstream media clown shows, then it's going to be very, very tricky for everyday investors. We have the Fed talking every 5 minutes as well, so it is a very, very challenging environment. Managing risk is always priority number one around here. Now, investor sentiment at the moment is showing that there is a lot of greed out there, which is set against a backdrop of the turmoil, but there are opportunities if you are looking deep enough. Now, for disclosure, myself or my clients may hold some positions in some of the names mentioned. Now, I have highlighted those on the charts. Now, if you are new to my channel, I like to use a combination of technicals and fundamentals. I'm told that I'm very good at removing a lot of the confirmation biases that you'll see from a lot of charts. As you all know, I do not use the magical hindsight indicator. I timestamp all of my work, which is massively important. I'm not a short-term day trader looking for little 20-cent, $1 moves. I'm looking for structural trends that will last weeks to months, for big gains, and I use systematic process. My work is really for everyone, for everyday investors, traders, financial advisors and money managers, and I'm told my charts are among the very best in the business, and if they don't make sense, let me know in the comments and I'll do my best to help you out. Now, my work is well known for my ability to highlight the big risk on, risk off turning points, and as I said before, my work is all time stamped. I'm not one of those analysts that make broad market calls 6, 12, 24 months before they start to play out. There's very few of us that go on the record with their work. I'm one of them, so hopefully you get some value from my charts. Now, to give myself a little bit of credibility before I get into it, some of my recent time-stamped calls, the market crash 1 year ago, the bear market rally last June, the exact market top in August, then the market bottom in October, the rotation back into tech, and you can go all the way back to the crash of 2020 where I got our clients defensive ahead of that. We have been buyers of stocks since October, just to clarify, and I do have a track record of being mostly correct, which helps in this field. So if you find value from my work, please do like, share and subscribe on YouTube, and feel free to follow me on Twitter where I post charts most days. Please pause the video, make sure you're comfortable with that disclaimer. So enough about me, let's dive into the charts. Now, if you need technical analysis software, I have recently partnered with TradingView. They're perfect and have an incredibly cost-effective platform. There's a link in the description for a free 30-day trial. Now, let's start off with real GDP. Now, we've already had 2 consecutive quarters of negative GDP. Now, I covered this chart 1 month ago and had a little bit of pushback on it from a lot of you economics folks, and I see both sides of the story. The problem that we have is the goalposts have, of course, been shifted. We all know that a recession is really defined by 2 negative quarters of GDP, which we have had. And I don't know about anybody else, but the current climate certainly feels like a recession. Job losses everywhere. We've got inflation going through the roof. There's a lot of negativity. So I'm actually working on the assumption at the moment that we are already in a recession. I understand that there's many of you that will disagree with that, and that's okay. But for me, we've had 2 negative quarters of negative GDP. We were told that the goalposts had suddenly changed and shifted, and I don't know about you, but I view that as shenanigans. So I'm working on the assumption and the data that price provides me. There's a lot of negativity. I think if you have an understanding of the stages of a bubble, which I'm sure many of you have seen the textbooks, we can apply and overlay the textbooks to the current S&P 500 and the current environment. And a lot of the bearish sentiment folks are expecting capitulation and despair. Now, although I certainly use primarily technical analysis, I am very much aware of this. I am open to this potential outcome, but we are not there yet. The stock market has, of course, been going up since October. We've, of course, been on top of it, but we are starting to see a narrowing of the breadth. Now, this is the S&P 500 ETF SPY. I'm sure we're all familiar with it. We are pushing up against, let's just call it a range here, but this is the 50% retracement level of the entire decline from January last year. But we are seeing a deterioration of breadth. Now, I'm using an indicator here that the percentage of stocks above their 200-day simple moving average. As the S&P 500 has been climbing higher, we are seeing a deterioration of market breadth. Now, for me, that's not really a massive issue at the moment. For me, it's really just about finding the stocks that are above their 200-day and finding the strength in the market. That's what my work is known for. Ultimately, breadth can expand if the S&P 500 breaks out above these levels. But whilst we are below these levels, there's, of course, a lot of chop. It's up, down. There's not any real structure, but there are stocks within that are trending higher, and I have quite a few examples for you today. We also have the triple Qs. I'm sure we have all seen the flight to safety into the technology space. We're talking about Mr. Apple, Mr. Microsoft, and recently Google, which has been a massive one this week. But the triple Qs are looking reasonably constructive. Like the rest of the market, however, at the index level, it's incredibly choppy. My work isn't primarily focused on at the index level. It's really about drilling down into the individual sectors and the individual stocks and finding the strength and the rebound levels that way. I'm not really using the triple Qs or the S&P 500 as my gauge for finding strength in the market. At the moment, I should add that we still have a couple of hours left to go in the session in Friday, but the triple Qs at the moment are hanging about traditional seasonality. We've got the financials continuing to cling on for dear life. But what I want to do this month with the analysis is really just highlight a couple of warning signals. I think probably us technicians get a reputation for being able to pinpoint the turning points for price, when to get defensive, when to then start to move towards a more risk on environment. But for me, there's a couple of things that I would be looking for to get risk off, and these are all charts that I've already communicated to our clients over the last month. But I think if we have an environment where the financials are dropping down below the financial crisis levels, we all know the situation with the regional banks. I'm sure many of you have seen the interviews with Stanley Druckenmiller over the last 2 weeks. If you haven't found those interviews on YouTube yet, they're absolutely fascinating. For me, he's the all-time great when it comes to my field of work. And what he's basically saying is that by the time this is all over, many companies will be dead and buried. To the other side, we have Michael Burry, who's just recently reactivated his Twitter account. Now, I take Michael Burry with a pinch of salt. He's predicted 15 of the last 2 recessions, but it's still very, very interesting to me to see, what the folks with the big reputations are thinking. But Stanley Druckenmiller, I would highly recommend watching those interviews. But for me, whilst the economy is, of course, undergoing a massive challenge, I think if the S&P 500 starts to dip below its 10-month moving average, which is a really good risk-on, risk-off indicator. If you observe it at the dot-com bubble, if you got defensive as it moved below the 10-month, you avoided all the damage. You buy back in as soon as it moves above the 10-month. And again, same with the financial crisis, the 2018 correction, and of course more recently as well. There are occasions where we get these little minor excursions when we get these standard corrections, but for me it is still a risk-on environment at the moment. But it's really about drilling down and doing the hard yards and finding the stocks and the areas. The copper is breaking down this week, which again really just confirms that the health of the economy isn't great. If you don't know the reputation of Dr. Copper, feel free to go and check out Investopedia on that one. And the copper gold ratio potentially testing big levels as well. So there's a lot of dynamics to the market at the moment. You've of course got the micro caps, which is a risky area of the market, potentially looking to break down. It's been flirting with these levels for the last few months. It is currently holding up, but again, if we start to see the micro caps break down, then that has the potential to take the small caps, to then take the mid caps, then the S&P and the Qs with it as well. There's always one index that gets the correction party started, but really what's driving it all is still the US dollar. It's no surprise to me to see that the S&P 500 and the triple Qs, etc., are coming under a little bit of pressure today. The dollar index is rebounding from logical levels. So if this starts to range and move higher again, there's probably a little bit of near-term pain for a lot of names. But again, there's plenty of stocks that are doing just fine and holding up very, very well, even in the current chop. The correlation with the US dollar index and the S&P 500 is there for all to see as well. So if the US dollar index goes up, you would probably expect the S&P 500, as I said, to come under pressure. To the other side, if the US dollar index breaks down, that's an environment where you'd probably want to see the S&P move higher from there. Now, I am about to walk through around 20 individual stocks and ETFs. If you're still here, it tells me that you're getting a lot of value from this free analysis that I upload to social media every month. So please do hit the like button, subscribe, send it to your friends, share it on social media if you have some followers. It would all be very, very much appreciated. But let's start off with technology and XLK. We know the tech space has been doing very, very well of late. Over the last week, it has started to chop and range a little bit. For me, it would be a further risk on environment if XLK can get above that 152, 153 level. Below these levels, I think you can probably expect to see a little bit of chop in tech, but uptrends will hopefully continue to move higher, and of course downtrends will continue to move lower. The current environment has something for absolutely everyone. I don't know what the downside to that is. If you're bullish on some stocks, you can buy them. If you're bearish on some stocks, you can short them. It's truly an environment at the moment where it's choppy, it's messy, but stocks and ETFs are trending in the direction that they're supposed to trend. So if the market is going to be range bound for the next year, I'm perfectly okay with that. It's a stock picker's environment. I myself am a stock picker. So certainly, if XLK can move above these levels, I think it's probably a further evidence that we're looking at a more risk-on environment for the technology space. Now, what I want to touch on is a chart that I posted to Twitter this week. I had a lot of emails and social media messages on this one. I appreciate all the nice comments. Thank you. What I've communicated to our clients this week is we are working with upside objectives here around 122 to 124. That would represent around 12% upside from the initial breakout. And if we can get a further bid in technology, then again that would then bring in a longer term target around 150. But like I said before, it's a messy market at the moment. I'm really just taking it week by week. I'm not saying that Google's about to move to 150 and the stock market's fine. I fully understand the other side of the coin, that we could collapse next week. But it's really an environment where certainly what I've been communicating again to our clients and members is that not to get overly aggressive in either direction. Batting singles is absolutely fine in the current environment, and this is one of the singles that's obviously been working very, very well. Again, Tesla has been working okay over the course of the last few weeks. Made a bottom call on the 19th of April, just highlighting the possible rebound levels. Now that has played out. I think as long as you're above that 165 level, we have applied a trailing stop loss to our alert, and it's doing okay at the moment. Same with Amazon. It's having a down day today, but if you have a look at the daily chart on Amazon, the stock itself has only had one negative day in the last 9. This is an active alert that we sent out on the 10th of April, and we are again working with massive upside objectives here around 147. The position is already up 10%, so again we'll see how things play out, but we are currently still bullish on Amazon for as long as the market continues to play ball. But to the other side of things, there are stocks that are under a lot of pressure. Again, I posted this one to Twitter during the week, just highlighting that PayPal has become a graveyard for investors, and it does look to be in complete free fall now. It's broken below the last line of defense for me. You'll probably get some kind of oversold rally sometime soon, but holding PayPal at the moment is very, very difficult to justify. If you're a long-term investor, I hope it works out. I don't want to see anybody lose their capital, but it's not looking good for PayPal at the moment. Same with QCOM. Again, if you want to go short on areas of the market, nothing wrong with that. I think if QCOM breaks below $100, then that's a big problem for QCOM. We've got levels dating back to 1999 and 2019, and the $100 round number is a massive psychological barrier. I think if QCOM gives up that $100 level, again, it's going to be a big problem for one of the $115 billion semiconductor companies out there. We've got Nvidia, again, coming under pressure at the moment. It's had a massive gain It's up over 100% since the start of the year. It is chopping about at logical chop levels, but I think if there's a further breakout there above that 290 level, then there might be a further 20% upside there. We've also got Berkshire Hathaway. Berkshire Hathaway was in our midweek letter, just highlighting that this is a big level for the stock. I think as long as you're above that 318, 319 level, then I think then you can probably still remain bullish there on Berkshire Hathaway. Obviously, Warren Buffett, we had the annual meeting last week, and it looked quite positive from where I was sitting. So we'll see how things develop there. But again, I think even though it's Berkshire Hathaway, which is an incredibly solid company, again, technical levels matter for me. I think if we were to break down below that 318 level, then that might be a bit of a problem. Now, some names that are looking quite interesting, again, more disclosures. But DraftKings had their earnings last week. Good reaction to earnings. I think that the level here for a further breakout is around that $25, $26 level. I think if there's a breakout above that, then DraftKings could well be off and running. We also have Monster, which one of the consumer staples names that we picked out. Again, we've got earnings out the way. The stop has advanced. We are above key Fibonacci levels, and we are now working with upside objectives there around $71. But again, market dependent. If the market falls off a cliff, systematic process will take us out the position, and that's really what we work with in the current environment. We've also got Apple, which we're working again with targets there around 180, 182. Our trail stop is up at 165. We've got Meta, again, trailing stop there. We are working with upside objectives there around 270. I think if you have a look at the XLC chart, the XLC chart is looking quite constructive. So if you have a situation where the communications sector is starting to break out, then that might be a further bullish catalyst for a name that's already ripped this year. You are getting towards late stage. I'm fully expecting this to pull back in a meaningful way at some point over the next month or two. But we are currently still remaining bullish on Meta. We've got Spotify, which is up 18% from the original breakout. Again, pullbacks and uptrends oftentimes offer opportunity, and I think as long as you're above the 137 level, then I think you can continue to hold Spotify. We've got Peloton. Good old Peloton it just seems to be one negative news catalyst after another. I myself, I'm not a fan of Peloton. Some of you might have seen a photo that I posted to social media this week. I'm a much bigger fan. I'm really more into CrossFit. So I have the Rogue Echo bike, which I think is a far more effective workout. And it just, whenever I see the news on Peloton, it never fails to amaze me. One negative catalyst after another, and again, we're now flirting with the lows from September last year. So again, if you're bearish on stocks, there are some stocks that will ultimately disappear. Could Peloton be one of them? I'm certainly open to that idea. There are a few ETFs that are looking quite constructive. Mexico went out at new 52-week high this week. Be interesting to see stocks around the world. There's plenty of ETFs. This is one of the ETFs from our members chart book. So Mexico breaking out. We've got the gold ETF, which is still range bound at the moment. Gold has been incredible this year, but it is now starting to pause. It is starting to chop about at the moment. We're seeing that with the gold miners as well. that have been ranging over the last week, pulling back a little bit. We've got Canada, which is again, it just can't seem to get above that 36.50 level. I think if Canada can get above 36.50, then that would then bring in further upsides there around 41. And then we've got the UK, I think above $35. Obviously, I'm sure many of you have picked up on the Scottish accent. But the UK markets are of course quite interesting to me. Of course, many of our clients and members, and above $35 would make sense there. And I've posted a chart today to Twitter for Bitcoin. I think everybody and their dog is currently at the moment posting a really bearish chart on Bitcoin, highlighting a head and shoulders pattern on the daily time frame, which is completely valid. But for me, the 15-week moving average is again very, very good indicator for risk on and risk off. The market definitely respects this level. It has done over the last few years. So we have pulled back to this 15-week moving average today, and at the moment it's currently holding up. But I think if you are a holder of Bitcoin and it does break below this 15-week moving average, hot on the heels of testing logical resistance levels, then again that's probably a little bit of short-term pain for the crypto space as a whole. As I'm sure you all appreciate, Bitcoin is the granddaddy of them all. So if you're still here, as I said before, please do hit the like button, share and subscribe. It would be greatly appreciated. If you have just recently stumbled across my work for the very first time, please do check out our website at honeystocks.com. We provide memberships to our premium work. If you want to have access to all of our best charts and our premium weekend analysis, every single Saturday we provide access to our commentary and our presentations. We also provide access to our high conviction investment trade ideas. I'll show you what that looks like in just a second because I get a lot of questions on that. Provide access to our 5-minute midweek halftime market update. Provide access to a wonderful community of traders and investors from all over the world. We provide access to all of our ETF chart books. We cover stocks, ETFs, commodities, and of course sectors and ETFs from around the world, as well as access to our complete technical analysis program. So if you are somebody that wants to build a systematic process and take your eyes away from all the headlines in the news, I'm told I've built one of the best technical analysis system process building programs out there. But just to show you what our trade ideas look like, this is a recent alert that went out for Tesla at the beginning of the year, which was a massive gainer. Meta, which was another massive gainer. This is the alert that we sent out recently for Amazon, which is currently up around 10% already. We've got Apple, which has been a big gainer. We are long and short, so Russell 2000 was a decent move to the downside there, where all the pain started back in February. But I am very, very unique in what I do. On our website, I log all of the high conviction ideas that we've ever sent out to our clients over the last 5 years. We put out on average around 50 to 70 high conviction ideas every single year, and the results probably speak for themselves at this point. But feel free to go and check out the types of stocks that you like to buy, the types of stocks that we like to recommend. We do not recommend pump and dumps, low quality stocks. It's all solid companies, solid names, and of course ETFs thrown in there as well. But I think if you are somebody that has a mid-term approach, I think if you are maybe somebody that's tried day trading and you keep losing and you can't make it work, then I think my work might be a good fit for you. I think if you're looking to learn about technical analysis and systematic process, I think if you're just too busy with work, life, family, business, to find stocks and be on top of things again, I think my work might be a good fit. And maybe you just want to be part of a community and you're sick of hunting around social media and want to have access daily to a professional analyst, then again, my work might be a good fit for you. But I would highly encourage you to check out our website. But if you haven't done it already, please hit the like button, and I hope to welcome you soon. Thank you very, very much for watching. Thanks.